Okay, thank you for joining everyone this afternoon. Welcome back to our Options Education webinar series. My name is Tony Zhang. I am the Chief Strategist here at OptionsPlay. And today we're going to be talking about how to trade options. And this is really a beginner's guide for those of you that are getting started with options trading. And I just want to start off by saying, options trading is not something that you master in a day. It's something that takes time to learn. So today what we're going to do is we're going to go through some of the basics, make sure you understand what are the best practices and things to look out for when you're starting out. But more importantly, what we really want to do is show you a completely different framework of how to go about starting options, and that's specifically regarding the OptionsPlay platform. It's designed to make your user experience of educating and exploring and learning and analyzing options much more intuitive and user-friendly. So that's what I really want to spend most of my time here today, is showing you guys this tool that's available to you free of charge at Firstrade, and showing you how to utilize this tool to get you started with the basic strategies for trading options. Now, before I jump into the actual webinar and talk about the topic here, I just want to remind people that Firstrade has recently announced that they're going to offer commission-free trading on all stocks, ETFs, options, and mutual funds. This is a game changer for those of you that are trading options, because options are typically commission heavy, especially compared to the dollar amounts that you're typically buying or selling an option at. So for those of you that have sold covered calls or looking to sell covered calls, or buy your first call or a put as a starting point, especially when you're starting out and you're just buying one or two contracts, commissions eat into a lot of that cost. So by having zero commissions, that's really going to help you efficiently be able to get in and out of trades. So I do want to put that out there for those of you that have traded options, and just a big reminder that by trading your options through Firstrade, you're going to be able to trade a lot more things that you may not be able to do at some other brokerage firms because of the commissions. And also, just to remind everyone that Firstrade has been rated Kiplinger's best online brokers in 2018 and #1 for ETF and bond investors. So with that, let's go ahead and get started. What I want to cover here today is two main strategies. These are two strategies that you would deploy if you're starting out with options. One is buying calls and puts, and one is selling covered calls. Now, these two strategies represent the strategy to speculate for those of you that have a directional view on a stock or ETF, and you want to take that directional view that you can buy calls and puts for in order to do that. And for those of you that are looking to generate income, covered calls is the easiest or simplest way for you to go about doing that using options. So we'll cover these two basic strategies, what they mean, how to deploy them, and also, more importantly, show you how to actually analyze them using OptionsPlay. Then I'll talk a little bit about stock analysis, because we are trading stock options. So it's really important that you understand what's currently going on with the underlying stock. That's going to help inform your decisions as to what strategies you're going to deploy using options. I will cover understanding the Greeks. For those of you that are newer to options trading, the Greek sometimes is a scary term, and a lot of people get turned off because we talk about numbers and math. But I really want to talk about it more on a high level so that you understand it conceptually. I don't expect you to memorize it or know how to do the math. The OptionsPlay tool will do all that work for you. And then we'll wrap this up by talking about some of the common mistakes people make when they're starting with options, so that hopefully help you avoid some of those common mistakes. Now, and lastly, what I will do is I will spend about 20 minutes of my time actually walking you through some examples using OptionsPlay, again, which is the free tool that's available to you here at Firstrade. Now, before I get started, can everyone locate their chat window in your webinar tool? And what I'd like to understand is just how many people here are new to options, meaning you've never traded an option. If you've never traded an option, please type no into the chat window. If you've traded some options before, please type yes, just so I get a feel for who's in the room. Okay, so it looks like a vast number of you have said no, okay? And that's good. A few of you said yes a couple of times. So for those of you that are brand new, welcome. I hope this webinar helps inspire you to kind of start getting your feet wet with options trading. We're gonna cover two basic strategies. this is not meant as if you're an absolute complete beginner and you're not sure what an option even is, then I do think that you may need some basic education about that. This is really for those of you that have explored a little bit about options. Maybe you understand what a call and a put is, but you really don't know how to go about trading them, what expiration dates, what strike prices to choose, the practical side of things. That's really what we're going to cover here today. Great. So, like I said, we're going to cover two basic strategies. The first one we're going to talk about is generating income. This is the first strategy that you're approved for when you start, when you sign an options agreement with Firstrade. You're first approved for selling covered calls, and then once you have some trading experience, maybe you have a little bit more assets, that's when you're approved for buying calls and puts. And so these two strategies, number one is to generate income. Number two is to speculate, okay? So make sure that we understand the difference between those two things. So when we're generating income, pretty obvious as to what that means. What you're effectively doing is you're selling a call option against the stock portfolio that you have. So this is only a strategy that you can use if you currently have a stock portfolio and you have stocks that you own at least 100 shares of, okay? So before we move forward, make sure that this is only for those of you that have a stock portfolio and you have stocks that you have at least 100 shares of, then you can sell covered calls for income. What you do is you risk selling your stock at the strike price that you choose to sell your call option at. We'll talk a little bit about that in terms of how to pick your strike price, how to pick your expiration date. OptionsPlay will actually walk you through a lot of this. But the general rule of thumb when it comes to selling covered calls is you want to sell roughly about 1 month out. So, options have expiration dates. So we usually, when we're selling options, we usually want to sell roughly about 1 month out from expiration. And you always want to sell out of the money calls that are above the current price of the stock price. So we'll talk a little bit about what that means and how to actually select this. And OptionsPlay will actually guide you towards this, but this is just a general rule of thumb. When you're selling options, you want to stick to roughly 1 month out, and you want to sell calls that are above the current price, or what we call out of the money calls. When we're speculating, this is really where we're buying call and put options. Now, one of the key differences between speculating with options versus stocks is that many times with stocks, you may not be able to short a stock. You may not have the margin to do it. You may not have the ability in your account to even short a stock. So what that leaves a lot of investors is looking for only bullish stocks, meaning they don't really look and they don't really keep an eye out for, or if they find a stock that they're bearish on, they kind of just don't do anything with it. With options, you can take both ways. You can speculate in both directions. So whether you're bullish on a stock and you think it's going to go higher, or if you're bearish on a stock and you think it's going to go lower, options allow you to take that view. And most importantly, it allows you to take that view with limited risk. So that is really one of the key differences between trading stocks with trading options, is that you can take a speculative view on a stock, higher or lower, but limit the amount of risk that you take. And that's a characteristic of options, which is what drives a lot of people, or drives interest in people to look at options, is this ability to take this bullish or bearish view, but with limited risk. So if you're bullish on a stock, you would buy a call option. If you're bearish on a stock, you would buy a put option. And generally, the rule of thumb when it comes to buying calls and puts instead of selling calls and puts is to usually buy about 1 to 2 months out. That's usually a good starting point for buying calls and puts. And you generally want to start with buying in the money strikes. So for calls, that means buying strike prices that are below the current price. And when you're buying puts, that means buying strike prices that are above the current price. So we'll talk a little bit about the details of that, but that's just a general rule of thumb of what you should look at when you're either selling options as a beginner or buying options as a beginner. So just a quick recap of what a covered call is. This is where we're taking the existing stock position in your account, and we'll walk you through some examples of this with OptionsPlay. But think of the stocks that you currently own in your account that you have at least 100 shares of. It's just sitting in that account. Perhaps it's generating some dividends. However, most stocks pay maybe 1-2% dividends. So how can you increase your yield, or how can you increase your income on the stocks that you own? You can do that by selling a call option, and that will generate income for you. And that combination of the stock that you own plus the call that you sold is what we call a covered call. This is the most popular strategy for trading options. About 50% of volume in options is in the single strategy alone. That's why it's the first strategy. And it's also a strategy that doesn't add additional risk to your portfolio. If you're interested in learning more about the strategy, we actually have a specific webinar just talking about covered calls. And I highly recommend you to take a look at that if you're interested in the strategy. Next, let's talk about speculation, buying calls and puts. So this is getting just a little bit more deeper into what buying a call and buying a put looks like. So buying a call, like we said before, is the bullish view. So if you're bullish on any stock or ETF, you can buy a call on that stock or ETF. And the outlook for doing this is you anticipate gains in that underlying stock or ETF. So if you have a stock that's trading at 100, you think it's going to go up to 110 in the next month, you can buy a call option. You can buy a 2-month call option that will allow you to profit if the stock goes up $10 over the next month. The risk of buying a call is limited to the premium that you paid for the call option. So the cost of that call option is what we call premium. And the amount that you pay for that call option is the most that you can risk. Similar to when you buy a stock, you buy a stock that costs you $100 and you buy 1 share of it, the most you can lose is that $100. Same thing with buying calls and puts. Your reward is actually unlimited upside reward. And this is really what's the attractive piece about options for a lot of people, is the ability to take unlimited upside reward, but have limited risk on the downside. So if you're wrong on your direction, you think the $100 stock is going to go to 110, but it actually ends up going down to $90 or $80 or $50, whatever that is, your risk is limited, but the upside return is actually unlimited. And that's really the key difference between the two. And the break-even price, meaning at what point do you profit on a call option, is the strike price plus the premium that you pay for that call option. So if you have a $100 stock, you buy $1 call, and you're buying a 100 strike call, then your break-even price is going to be 101. Now, you don't have to memorize this. The tool actually does all of these calculations for you. It'll tell you exactly how much risk you have, what your potential rewards are, what your break-even price is, and even explains it to you in plain English, which is why I'm not spending a lot of time illustrating these concepts, because these things, as important as they are, we actually do these calculations for you. On the bearish side, this is where you want to buy puts. So if you're bearish on a stock or ETF, a stock trading at $100, you think it's going to go down to 90, you should buy a put option on that. This is really where you anticipate a decline in the underlying stock or ETF that you're trading. Again, your risk is limited to the premium that you paid for that put option. Your reward is also unlimited upside reward as long as the stock keeps moving lower. And the break-even price on a put option is simply the strike price minus the premium. Okay, so let's actually go through some examples here. And what I want to first point out is really talking about when you're speculating, meaning if you're buying a call or buying a put, the most important piece that you should think before you buy a call or a put, or even think about buying an option, is first understanding the stock analysis piece. Now, this is kind of where, for those of you that are already trading stocks, ask yourself, how do you do your analysis on the underlying stock? Are you using technical analysis? Are you using fundamental analysis? Or are you using other forms of methods like statistical or, more esoteric ones, even like, there's plenty of guys that will use star maps to determine where they think the markets are going to go. There's lots of different ways to determine whether you're bullish on a stock or bearish on a stock. But that directional view that you have on that stock is the most important factor to consider before you start trading options. And with that stock analysis, you should have an exit plan. What I mean by that is if you have a stock that's trading at 100, just because you're bullish on the stock is usually not good enough. You need to have an exit plan. You need to say, I think the stock will go to 110, or I think the stock will go to 120. Some kind of target price to say that, hey, I'm correct on the trade, on my analysis. On the same token, you should have an exit plan on the downside. So it's this $100 stock. You think it's going to go to 110, but what if it goes back down to 95 or 90? You should have an exit plan on both sides to say when you're correct on the trade, and also when you're incorrect on the trade. So a lot of technical analysts who use charting will typically use their charts like support or resistance levels to determine when they've hit their target and they're correct on their analysis, and when they're wrong on their analysis and it's time to bail out of that trade. So please type into the chat window, what type of analysis do you use when you're trading? Do you use technical analysis? Do you use fundamental analysis? Do you use charting? Do you use statistical methods? Just so I get a feel for what type of research you guys do when you're trading stocks currently. So far I have a few technical analysis, a couple of, or actually a lot of technical analysis, charting, technical, a couple of fundamental. So and there's no right or wrong here. This is just about understanding what your form of analysis is, making sure that that your direction is the most important factor to determine whether you want to buy a call or a put. But more importantly, regardless of what form of analysis you do, make sure you have an exit plan. So for technical traders, this tends to be, in my opinion, a little easier because it's easy to try to figure out when you're right or wrong using a chart, because the chart either goes higher and hits the target that you want, or it goes lower and doesn't go in the direction that you want. For fundamental, it's a little more difficult because you're thinking about the stocks from a fundamental perspective. You're thinking overvalued, undervalued. And sometimes it's a little difficult to understand, is my analysis correct, right? So, you might think Apple is undervalued, but at what point do you consider yourself correct? And what point do you consider yourself incorrect? It's a little harder to do that. So the one thing that I do want to point out, though, is for technical traders, these trades tend to be shorter term. When we're looking at charts, we're typically looking out a few days, a few weeks, possibly a few months out. But most technical traders that I've worked with, and I've worked the last 14 years with technical traders, tend to be more on the shorter end of the spectrum when it comes to analysis. That's why when you're trading using technical analysis, anywhere short-term to swing trades, you're using anywhere option expirations that are 1 to 3 months from now. That's typically the expiration dates that you would use as a technical trader. For those of you that are fundamental, this is where it gets a little more difficult because it depends on the type of fundamental analysis you do, but they tend to be a little bit more longer term. Most technical or most fundamental traders basing their decisions off of overvalued or undervalued stocks take a little bit more time for those to play out. So you would usually use 3 to 12 month expirations when you're trading options. So before we move on, make a mental note to yourself, which one do you fall under, and making sure that you select a trading strategy or an expiration date that best suits your time frames. So last thing I want to cover before we kind of move on to some of the common mistakes that people make is understanding the Greeks. This is the fundamental difference between buying stocks and buying options. When you buy a stock, when it goes up by $1, you make $1. If it goes down by $1, you lose $1. So very straightforward, dollar for dollar. When you're buying an option, that's not the case. So how much does your option increase in value or decrease in value if the stock goes up by $1 or down $1? That's what delta tells you. And delta tells you the change in the option price with respect to the change in the stock price. So if you buy a call option and you see the delta is 0.5, what that means is that when the stock goes up or down by $1, the option price will move by half that amount, so 50 cents. So delta tells you the ratio of when the dollar moves up by $1, how much does the option price move up by. This is the fundamental difference between buying stocks and buying options, because you don't get dollar for dollar exposure, and one thing is that delta actually changes. It doesn't stay constant. So it's not like when it's delta is 0.05 today, it'll also be 0.5 tomorrow, it'll also be 0.5 the day after. It changes. So this is one of the things that's really important to understand, is how option prices change with respect to the stock price. The other thing that's fundamentally different between buying stocks and options is that stocks, once you buy a stock, you can hang on to it for as long as you want. If you buy a stock for $100 and it stays at $100 for the next year or 10 years, you make or lose no money because the stock is exactly what you paid for. With options, that's not the case either. With options, when you buy a stock option for $1 or $2, that option will actually decay in value over the lifespan of that option. How much does it decay by? That's what theta tells you. Theta tells you the change in the option price with respect to time. So theta actually works against you when you're buying an option, because when you're buying an option, you want it to go higher. And theta is actually eroding the value of your option. When you're selling an option, theta is working in your favor. So this is really why a lot of professionals prefer to sell options versus buying options, because of theta, because time consistently marches on and theta constantly erodes the value of an option. That's why it's generally a lot of beginners, what they'll do is they'll start by selling cover calls because it puts this theta in their favor, versus when they're buying calls and puts, theta is always working against them. So it's sometimes easier to start by selling options, getting a feel for selling cover calls before going to the other side of buying calls and puts in order to speculate. But those are the two fundamental differences that's important to understand when you're buying or selling options. However, what I want to point out is that you don't have to know how to do any of this math, nor do you have to know how to calculate it. Our platform actually does all of that for you, because when you're buying a $100 stock, you're in your head, you're not thinking about delta, you're not thinking about theta, you're thinking about, I think the stock's going to go up to 110. OptionsPlay will actually do all the calculations for you and show you exactly what your option will be worth if the stock does go up to 110. And you can even say, I think it'll go up to 110 in a week or 2 weeks or a month. It'll actually also calculate the amount of effect that theta has on your option. So just keep in mind that this is more so for you to understand from a conceptual perspective. You don't have to know how to calculate any of these, because OptionsPlay does it for you. So lastly, before we actually move on to the OptionsPlay piece, I just want to cover some of the common mistakes people make. Number one, when you're buying options, when you're looking for bullish or bearish opportunities in a stock or ETF, one of the common mistakes people make is they want to hold on to a trade until expiration. This is really what you don't want to do. And this is really because of theta. We talked about theta erodes the value of an option. So when you're buying an option, you want to get in and out quickly. This is talking about that having that exit plan. So if you think the stock's going to go up to 110, the second it hits 110, get out of the trade. You don't have to keep hanging on to it, because if you keep hanging on to it, theta is going to erode the value of your profits. Secondly, when you're buying options, we see people tend to use expirations that are too short. Anything less than 2 weeks is really not suitable for speculation. You want to go further out. You want to go at least 1 to 2 months out when you're buying an option. And lastly, one of the most common mistakes we see across the board is not having an exit plan. Meaning people will say that I think the stock is bullish, it's trading at 100, so they buy a call option, and maybe the stock goes up to 105, 108, 110, but they don't really have an exit plan because they didn't plan ahead to say, well, at what point do I consider myself correct? And they end up hanging on to that trade for too long. And they do this where they hold on to a trade until expiration. And even though they're right on their analysis, they gave up a lot of their profits because of theta. So this is really one of the key differences between trading stocks and options, is that you need to have an exit plan and you need to be able to execute on that plan very, very quickly. When you're selling options for cover calls, one of the most common mistakes that we see people make is they sell calls that are too aggressive. What that means is that you're selling a call that's too close to the current price, because that gets you a lot of income. And it sounds like it's nice because you get a nice hefty income. But what ends up happening is that because you're selling a cover call that's very close to the current price, they end up selling the stock basically at the current price. And what that means is that you're not going to be able to participate on the upside of the actual of the calls of the stock. And you're in that stock because you think the stock's going to appreciate in value. So make sure that you sell a call that's out of the money. Really important to do that. Second mistake that we see a lot of people make when they're selling cover calls is they're using expirations that are too long. Same thing, trying to chase as much yield as possible, so they go 3, 4, maybe 5 months out, and they sell something that gets them a lot of income. But this is usually not a good use of your cover call, because you can sell shorter dated calls, receive less income, but you can do it many more times, which actually makes up for the lack of income that you might get on a shorter dated call. And lastly, for cover calls, same thing, not having an exit plan. I don't have enough time to cover the exit plan rules for a cover call, which is why we have a separate webinar specifically on this. So for those of you that are interested in cover calls, I highly recommend you to take a look at that webinar. So with that, let's actually move on to the actual OptionsPlay platform and show you guys some real life examples, which is probably what you guys are really looking for. So The OptionsPlay tool you guys can find under the Firstrade Options Trading tab. So if you go to the Trading tab, click on Options, there's a button here on the right that says Options Wizard. I actually see a comment here. Can you give a few real-life examples? Absolutely. That's exactly what we're going to do here today. So when you launch the OptionsPlay tool, this is the screen that you get. And I want to contrast this a little bit. I'm going to walk you through this real quick. And then what I'm going to do is I'm going to contrast this with the option chain. This is where most options traders start trading. This is where you have calls on the left, puts on the right, and you have every single possible expiration and strike price listed with the pricing and a bunch of other statistics around that. I find this page really, really confusing for most people, especially if you're a beginner. It's really difficult to understand where should I start, what expiration date, what strike price. So what we wanted to do when we started this company was build a whole new user experience around options trading that made it easier to learn, explore, and analyze options, specifically designed for those of you that are on this webinar today who's brand new and may not know where to start. So what we've created is 3 tabs. You have trade ideas and watch list here on the left-hand side of your screen. In the middle, we have our security analysis panel. And on the right, we have trading and income. These 3 panels, we call it the what, the why, and the how of trading, because when you're starting your day, you want to know what symbols should I look at. So we have fresh trade ideas that are scanned for you, bullish and bearish ideas every single morning. You have your watch list that allows you to keep track of what's currently going on with the markets. We have pre-built watch lists for you so that you can look at all the sectors and you can hone into the sectors, or you can create your own watch list with the stocks that you own. I actually will use one of the watch lists here, the cover call watch list today for our demonstration. The middle panel here in the middle is our security analysis panel. This is designed to help simplify your technical analysis. Many of you said that you use technical analysis for your trading. Many of you may use moving averages in your trading. So what we do is instead of showing you moving average, which you can still put onto the chart, we're going to show you the 1 month and 6 month trend. So we're going to interpret the moving average for you and give you an idea as far as what the short-term and long-term trend of the stock is. And we also take a look at the relative strength. This is using the 6-factor technical analysis model to give you an idea as far as how strong is Salesforce CRM compared to the other stocks in the market. And it gives you a score of 1 to 10. So this has a score of 9, telling you this is a very strong stock, outperforming the overall market, so that not only do you get an idea as far as what the trend of the stock is, but also what the relative strength. And this allows you to type in any stock and immediately see what the 1 month and 6 month trend is. As you can see, Salesforce is contrasts quite a bit with MU. Micron Technology, as you can see, it's got a technical score of 1, meaning a very weak stock, and the 1 month and 6 month trends are bearish. So this allows you to type in any stock and quickly get a feel for what's currently going on with the stock without having to pull up a lot of charts, put on a lot of indicators in order to do all that analysis. You can do that at your fingertips, have access to most of the information that you would typically use technical analysis for. And then we have important information like earnings, dividends, and price action data here at the bottom. Now, once you have a directional view, so we talk about having a directional view. So on Micron, I might have a bearish view. On Salesforce, I might have a bullish view. Once you have your directional view, how do you actually take advantage of that? And that's really where trading and income comes in. So we talked about 2 different ways of utilizing options. One is speculation, and that's what trading is, and income is, which is what we're talking about, selling covered calls. So we'll talk about each one of these separately, but the idea is that if you're bullish on Salesforce, we talked about you can buy a call option, but the question is, what call option do you buy? And traditionally, you'd pull up a page that looks like this. You'd look at all the expiration dates. You look at all the strike prices. And if you're a knowledgeable trader, and you've had some experience trading, you would know that, for call options, I would literally typically go about a month maybe or so. So you'd have to remember, okay, I'm going to look at the October 12th or October 19th expirations, which are 36 days away. And then you'd have to remember what I said before about you typically want to start with buying in the money options. So you might start around this 145, 150, 155. These are starting points. Now, this is presuming that you know exactly what to do. Now, most of you here on this webinar, I'm guessing, may not do that. So that's why we created OptionsPlay. You can type in any stock and either click on I'm bullish or click on I'm bearish. And we're going to show you 3 strategies that allows you to start off and allows you to compare, which is really what you're looking for when you're starting off, is where do I start and how do I analyze where my starting point is. So here we're showing you that for Salesforce, you can buy 100 shares of the stock, which will cost you $15,000. So for those of you that are brand new to options trading and you've traded stocks before, this strategy you're probably familiar with. However, what we're saying here is we're looking at the October 26, 155 call. This is telling you this is where we think is a good starting point for you if you're bullish on Salesforce. As you can see, buying a call option only costs you $625, a very small fraction of the cost of buying 100 shares, about 3% of the underlying cost. Or you can buy the strategy here on the right, which is a vertical. So this is a more advanced strategy. I'm not going to take a lot of time to get into this because most of you said that you've never traded an option before. But as you progress with your education, as you learn more how to trade about options, you want to start focusing your attention on the strategy here on the right. And we're going to see in a few seconds as to why. But the goal here is to really help you progress from the left-hand side to the right-hand side as a trader. Now, this P&L simulator here at the bottom is really what I'm talking about. Instead of having to think about delta and theta and how those affect your option prices, you're thinking as a trader that Salesforce is at 155. I think it'll go up to, let's say, 160. Now, there's not much here from a technical perspective. However, I can say that this move from 137 to 149 was about a $13, $12 move. So maybe you project that same move from about 150 about to 162. So let's say you think Salesforce is going to go to 162. How much return do you actually get? So if you had bought the stock, you make a 4% return. If you bought the call option, you make a 12% return. If you bought the spread here on the right, you make a 35% return. In my opinion, none of these trades look spectacular, meaning it's not really attractive in my opinion. But this is where you can use this tool to say, how far does the stock really need to go before these strategies look somewhat attractive? So as you can see, the stock really needs to move to 167 before you start to see some interesting numbers here. So on this call option, you make a 100% return if the stock goes up to 167, 142% return on the call vertical if it goes up to 167, and a 7% return if you had bought the stock. Conversely, you can also say, like I said, you should have an exit plan on the downside. What if the stock goes back down to 145 or maybe even 140? This allows you to really understand your risk. As you can see, if you had bought the stock, you'd be losing $1,500 if the stock went down to 140. If you had bought the call option, you only lose $625. So you actually risk less than half the amount that you would risk if you had bought the stock, even though it only cost you 3% of the amount of capital it would take to buy 100 shares of the stock. You actually lose less money, and on the right-hand side, you actually lose even less money. And that's really why you want to learn as a trader to progress here to the trade on the right-hand side. But we're going to start off by just talking about a simple call option. And for those of you that are looking to learn, this is really where we take this approach of plain English. We don't like a lot of the terminology in options. Sometimes that scares a lot of people off. We want to display everything in a plain English so that you can understand that buying this call option is a bullish strategy. You have a limited risk of $625. The strategy will profit if the stock closes above 161.25 on October 26th. So this explains to you exactly what the stock needs to do in order for this strategy to be profitable and gives you that understanding of what you're actually going to be trading. But more importantly, I highly recommend you to really play around with the P&L simulator because that allows you to really understand what your expected profit is if the stock goes higher, but also on the same token, what the expected losses are if the stock goes against you. And this is really the number one reason why we see a lot of traders buy a call option without understanding what their potential reward is and what their potential risk is. They just learn that buying a call option is good if I'm bullish, but a lot of times what ends up happening is maybe the stock does move higher, but it doesn't move high enough. Let's say the stock only goes to 160. As you can see, if you had bought the stock, you make roughly a 3% return, but if you have bought this call option, you actually lose money. This is what confuses some people is that, hey, I was right on the fact that Salesforce went up. How am I losing money? And that's really theta. So theta is what we talked about. The value of an option will erode as time goes by. So if the stock goes up to 160 tomorrow, yes, you will make some money. However, if you continue to hold on to this trade, as you can see, the option price will actually erode in value. This is the theta that we were talking about. So if you continue to hold on to a call option till expiration, all your profits will actually evaporate. And this is really why we said one of the common mistakes that you need to avoid when you're buying a call or a put is to make sure you don't hold it to expiration. If you hold it to expiration, you're going to give up some of your profits. So make sure you understand this concept is really important. And one of the best ways to learn this is using our P&L simulator. So let's say you think the stock's going to make a move up to 162, but you think it'll happen by the end of let's say you think it'll happen on the 1st of October, right? You think it'll go to 162. As you can see here, if you had bought this call option, you make a nice 42% return instead of a 4% return on the stock. This is the power of options that allows you to really leverage a directional view with limited risk, meaning no matter what happens, even if the stock goes down to zero, you're still only going to lose $625. You cannot lose more than that. Versus if you bought 100 shares of the stock, you're going to lose $15,000 if the stock went to zero. So this allows you to take that directional view with leverage, but on the same token, if you're wrong, it limits the amount of risk that you can take. And that's one of the more attractive pieces about options trading that brings a lot of people to looking at options. Now, one of the greatest things that we've built for the integration with Firstrade is that if, let's say, we're looking at this October 26, 155 call, which in my opinion is not a spectacular trade. As you can see, the stock really needs to make a big move in order for you to make some nice sized profits. So maybe this is a trade that you might pass on, but regardless, if this is a trade that you do decide you want to do, you can hit the trade button. What we have here is we tell you everything in order so that you understand what you're actually trading. But more importantly, we have what's called a strategy checklist. So we talked about beginners making some mistakes. We wanted to make sure that we want to help you avoid making some of those mistakes. So we have is we check this trend of the stock, we check the trend of the market, we look at the OptionsPlay score. As you can see, this OptionsPlay score is not very good, telling you that the risk reward on this trade is not spectacular. As we saw before, the stock really needs to make a really big move before this strategy is profitable. So this might be an indication that perhaps this is not an option you want to trade. And I want to make that very clear, is that just because there is options out there does not mean that you should trade options all the time. There are benefits to trading options, but not every option makes sense. And that's really what OptionsPlay is designed to do. When you're looking at a page that looks like this, it's really difficult to tell which option makes sense and which options don't. OptionsPlay does our best in helping you, guide you by giving you these types of things. We also check to see if there's earnings between now and expiration, and we also check for spread and liquidity. So liquidity is something that you typically don't worry about when you're trading stocks, but it is something you have to worry about when you're trading options. So that's one of the things that we make sure that you understand is the liquidity of something before you trade. And once you decide that this is a trade that you want to make, you can hit the preview order button. What that does is it actually pre-fills your first trade order ticket. This way you don't have to enter anything manually. As you can see, there's a lot of things you need to enter manually. So you have to do buy to open, the number of contracts, symbol, expiration date, strike price, call or put. There's a lot of room for error there. So what we do is we automatically fill it out for you so that we avoid any possible mistakes on the order entry screen. So that's just a very quick overview of how you can utilize our tool. I'm going to walk you through one more example. Let's look at Micron. I'll walk you through one more example. So let's say instead we're going to flip the coin here. We're going to say we're bearish on the stock. So Micron, as you can see, and keep in mind that this is by no means a solicitation to trade the stock. This is simply, I'm using this for illustrative and educational purposes. I just pulled up this stock because it's a stock that many of you follow, many of you are familiar with, and it's also currently in a very bearish trend. So 1 month and 6 month trends are bearish. Technical score of 1 is very weak, telling me this is a very weak stock in the market, down 4.5% today. It looks like it's really fallen apart. So let's say you think it's going to continue going lower. So what can you do? So let's first take a look at a chart. Maybe we think it's going to go down to 35. So as you can see, first of all, what you can do is you can click on I'm bearish on Micron. It's going to present to you 3 bearish strategies as a starting point. You can short 100 shares of the stock, which some of you may have the ability to do, but many of you may not have the margin or the ability to do that. So let's look at buying a put option. This is a put option. Instead of costing you $4,000 in margin requirements to short the stock, it'll only cost you $370 to buy a put option versus buying this put vertical here again. We're not going to get into that strategy. Only costs you $307. So all of these strategies allow you to profit if Micron goes lower. The question is just how much profit and how much risk do you take if you're right and when you're wrong. And that's what our P&L simulator does. So we talked about what happens if Micron goes down to 35. As you can see, if you had shorted the stock, you make a pretty nice 16% return, 15.78%. I think that's pretty good. But if you had bought the put option, you make 116% return. And keep in mind, you're only risking $370. And if you're right, you're going to make $430, 116% return. And here the strategy on the right, which is clearly the winner here, but again, not going to get into that because that's a more advanced strategy, only costs you $307. And if you are right and it goes down to 35, you make 160% return. So actually more profit, even though you're putting up less capital to do so. And that's really, again, why this is the strategy that as you learn and progress as a trader, you want to start progressing yourself from the strategy here on the left to the middle and eventually over here to the right. And this really allows you to say, okay, what happens if, and Micron is a big mover, right? It moved up from 46 up to 54 in the matter of a couple of weeks, a few weeks ago. So what happens if it also moves up another 10 bucks from now? What if it moves up to 51? What is my risk? So as you can see, if you had shorted the stock, you risk $944. Versus if you bought this put option, you lose $370, less than half the amount that you're risking here if you shorted the stock. If you bought this vertical here, you're only risking $307. So no matter what happens, even if Micron goes up to 100, you're still limited to the amount of money you've paid for this put and put call and the vertical in terms of how much money you'll actually risk. Versus when you're shorting the stock, your risk is unlimited. If the stock goes to 100, you're going to continue to lose money, more and more money as the stock continues to go higher. When you buy that put option, you don't have that risk. So no matter what happens, you're limited in the amount of risk that you have. And that's, again, why this asymmetrical payoff of getting unlimited reward when you're right, but limited reward when you're wrong, that's really the key of what people are really going for when they're speculating with options. So that covers how to use options. That's just two very quick examples of how to utilize options to take a bullish or bearish view on our options play. Again, type in any stock, either click on I'm bullish on the stock. So here's Goldman. Maybe you're bullish on Goldman, so you can click on I'm bullish and be presented 3 bullish strategies, or click on I'm bearish and we'll send you 3 bearish strategies. So regardless of what your views are, regardless of what stock you're looking at, you can use this strategy, you can use this platform to, number one, get a gauge for where the stock is going and where you think it might go, and then quickly leverage that into a bullish or bearish strategy in a matter of seconds. So let's just go back to selling cover calls. Again, this is where most popular trading strategy is actually selling cover calls. This is taking the existing stocks in your account and generating income from it. So I have a list of stocks here on the left-hand side. These are stocks that very well many of you may own. I purposely picked large cap blue chip stocks because these are stocks that many of you probably own in your portfolio. And what we do is a similar type thing, but instead of showing you bullish and bearish ideas, we're showing you a cover call and a short put idea based on your preferences. And one of the things that we do is we allow you to set your income settings here at the bottom. So remember that before you use the income tab, there's a button here at the bottom that says income setting. We go over this in detail in our cover call webinar. And it allows you to put in your desired time frame, meaning do you want to sell short dated calls, medium dated calls, long dated calls, and what's your risk tolerance? Are you conservative, optimal, or aggressive? I'm not going to get into the details of each one, but when you click on one, it'll actually tell you what it's suitable for. So for those of you that you definitely want to click through these and see which risk tolerance you fall under, which time frame you fall under. And once you do that, all you have to do is click on a stock, and we will actually decide, or we will help you find the expiration date and strike price that best suits your criteria. Now, if I was looking at Johnson & Johnson and I wanted to sell a cover call, traditionally I'd have to pull up a page like this. I'd have to look at all the available options. I have to look at all the available expirations. I have to remember that when I'm selling options, I need to go about a month out. Then I have to remember I have to sell out of the money calls, and I have to pick something as a starting point. A lot of times these numbers don't mean a lot. I have to then put them into a calculator to calculate yields and things like that. It's a lot of work. What we do is we automate that whole process for you. It just tells you exactly, first of all, allows you to enter the number of shares you own. So let's say you own 300 shares of Johnson & Johnson. It'll show you to sell 3 contracts of the October 5th 144 cover calls. Johnson & Johnson pays a 2.6% dividend yield. So if you own the stock, you're getting a decent yield on this stock. However, as you can see, by selling the October 5th 144 calls, you're actually going to generate an additional 5.35% annualized return on the stock. So that brings your total yield on the stock to almost 8% by adding cover calls. This is the reason why people look at adding cover calls to their portfolio to generate this income, because you're going to generate $141 in income over the next 23 days. So that's 0.75%, which doesn't sound like a lot, but because you're able to do that over 23 days, you can do this over and over again, and that annualizes out to about 5% over the year. That's really why you can increase your yield from Johnson & Johnson about 2.5% to almost 8% by adding cover calls. This is really the attractiveness of adding cover calls and income strategies to your portfolio. Let's move on. Let's take a look at Microsoft. Many of you own Microsoft. So do you own shares of Microsoft? You click on yes, type in the number of shares that you own. Let's say you own 200 shares of Microsoft. Microsoft pays a 1.5% dividend. So if you own the stock, that's a decent dividend, but it's certainly not hefty by any means. This is telling you to look at the selling October 5th 117 cover calls. This is basically saying the stock's trading at 111. When you're selling a 117 call, you're basically saying, I don't think the stock's going to go above 117 by October 5th. And what that does is it generates a 7.6% yield on a stock that pays a 1% dividend, which brings your total yield to 9%. So you're going to generate 0.5% of yield in the next 23 days. And if you're able to do that throughout the year, that's roughly almost 8%. That's going to increase your yield substantially on your portfolio if you own Microsoft. And this is all done without having to search through pages and pages of option chains, doing calculations manually. It already points you directly to the starting point that meets your criteria and gives you all the analytics to decide, is this a trade I want to make? So here's American Express. It pays a 1.2% dividend yield. Let's say you own 100 shares of American Express. As you can see, the yield here is only 2% on this cover call. So as you can see, the yield's not very high, and this might be a reason to maybe not sell cover calls on American Express. So this gives you all the information as to where to start, what the yield is, so that you can make a decision in just a matter of a few seconds, not a matter of a few minutes. So for those of you that like to sell cover calls and you're going to do this every few weeks, this is going to shave the time that you spend from a few minutes down to just a few seconds. And once you're ready to place that trade, you again hit the trade button. You can hit the preview order button, and that allows you to pre-fill the ticket for you so that you don't have to enter any of these details on your own. So with that, that's just a quick recap of all the things that I wanted to show you. Please check out the OptionsPlay tool. It's available to you free of charge. And just a reminder, it's under the Options Trading tab, and there's a button here that says Options Wizard that will launch the OptionsPlay tool. It's a free tool that you guys all have access to. I highly recommend you to take a look at it. If you're starting out with options, this is really designed to help make that process a little bit easier. Like I said, this webinar can't teach you everything, but it will show you how to go about taking what you've learned and really helping you apply it in a more practical sense. So with that, what I'm going to do is I'm going to open this up for Q&A. If you have any questions, please type them in the chat window, and I'll spend as much time as I can answering as many questions as possible. Linda's asking, how do I get to that chart? I'm not sure which chart you're referring to. If you can let me know, I'm happy to tell you that. Natty's saying, can you please explain what happens if you do not have the stock? If you're referring to cover calls, you cannot sell a cover call if you do not own the stock. So again, cover calls is a strategy only for if you have at least 100 shares of that stock. The other chart with all the options. Oh, okay. So this is when you're on the OptionsPlay page. When you're on your Firstrade page, at the very bottom, there's a little box here. It allows you to get a quick quote, and there's a button here that says option chain. When you click on the option chain, that will pull up the full option chain, that's exactly what I'm displaying here. Gleb's asking, what is the impact of volatility on these strategies? Great question. So implied volatilities, so let's say American Express, or let's go back to the CRM example, because I want to use an example that we just looked at. the question was, what is the impact of volatility on these strategies? The answer is it's not much, but it certainly has some impact. So we talked about what happens if the stock goes to 162. Maybe this happens on October 1st. What happens if the volatility of Salesforce goes higher or lower? What does that impact? So as you can see, when volatility goes higher, the option price will actually go higher. When volatility goes lower, the option price will actually go lower. So volatility is a direct impact to the option. The higher the volatility, the higher the option price. The lower volatility, the lower the option price. Fabio is asking, how are trade ideas proposed? So trade ideas are basically based on technical scans. So these are bullish. So all the bullish trades are stocks that have bullish trends and have triggered a classic technical buy signal. So these are based on CCI, William Percent R, Money Flow Index, RSI, basically very standard buy and sell technical signals, but they also must have bullish trends for both short-term and long-term for bullish ideas, and bearish trends for bearish ideas. Giuseppe is saying, where can I find the link to the cover call webinar? So we'll send you a link right afterwards with the links to all the recordings. You can find the one on the cover calls there. Spread in price quite wide. Why is that? Giuseppe, if you can tell me which one you're referring to. Richard, thank you very much. The visual presentation in OptionsPlay is great. I really like it a bunch. Thank you very much. I really appreciate it. That's really why we created this. We wanted you to have a new user experience with options trading because we realized that when you show screens that look like this, no one knows where to start. And even if you know how to use this screen, it's not useful in many, many ways. So if I'm looking at Apple and I'm bullish on this and I'm looking at whether I should buy the 220 call or the 225 call, this just tells me what the price is. So what happens if the stock goes up to 230? How do I know how much money I make? Because that's how you're going to decide whether you're going to buy the 220 calls or the 225 calls. Or if the stock goes lower, how much money do I risk? These are the decision factors that you need to decide as to which one you're going to buy, but you don't get that information on this screen. That's why we created this tab, so that you can actually modify this. So you can actually say, well, let me look at two different calls. Let me look at the 155 versus 157 or 155 versus 160. Put them side by side and now say, what happens if the stock goes up to 162? How much money do I make? As you can see here, I actually lose money on this trade. So then I know I should not trade that 160 call. These are the information that you need in order to place a trade. And we want to give you this information so that you have all the information and you understand your risk. That's really the important piece, is understanding your risk. Because if you don't understand your risk, chances are you'll buy a call or a buy put and you end up losing money. You don't know why. And that's when you stop trading options. Is whenever you lose money and you don't know why that happens, that usually stops people from trading. And this is really designed to keep you informed before you place a trade so that even if you lose money, you understand why that happened. Any other questions, Giuseppe? I don't know I ever got an answer to the question regarding the spread. I wonder what the success rate for retail investors in using these strategies. So that really heavily depends on the tools that you have. I always say that your success in options trading is not how you enter your trades. It's about how you exit your trades. Making sure having that exit plan is by far the most important things in order for you to decide success in options trading is having that exit plan. If you hold on to a call too long, if you're long that call, chances are you're going to lose money on that trade. So making sure that you understand what your exit plan is before you get into a trade is critical to success as a starting retail trader. Was one of the stocks that you showed. So option spreads are much wider than stock spreads. That's just the reality of trading options, is that your spread is going to be much wider by trading options versus trading stocks. Are there more beginner sessions available? Yes, there are plenty of beginner sessions available in the replays, so I highly recommend you to take a look. We take a very beginner approach to all of our webinars. Very few of our webinars are designed for advanced traders. Every one of these is designed to basically help you get started with trading. Maybe you can show which price we pay in placing a trade. Okay, so if you're buying this call option, $625 is roughly what you would pay. As you can see, the midpoint is 610. The asking price is 625. So if we hit the preview order button, this allows you to place that limit order at 625. or you can place it anywhere between 625, 595 by 625. So you can place your limit order anywhere. So you can say 615 maybe as your limit order, and then you can send that order for trading. Any other questions? If not, I just want to thank everyone for taking the time out this afternoon. I really appreciate everyone taking the time out. I hope you guys find this information useful. And again, please make sure you take a look at the OptionsPlay tool. It's free of charge, available to you. Highly recommend it. It'll make your life just that much easier, especially when you're getting started, so that you don't have to see a lot of the confusing things, a lot of the confusing terminology that turns people off. So thank you very much. I hope you guys have a great afternoon. I'll be back here in about 2 weeks to do another webinar for you guys, and I'll see you all there. Thank you so much, and have a great afternoon.